he was smiling like a vulture as he rolled up the horticulture. Ignited it and said, I hope the vapors don't insult you. But I replied, denied, but mixing weed and hot. He said it was 9 up and down like he agreed a lot. Lord said we need a plot. I comply, let's leave the spot. Hopped in the Granada, he's impressed by the beat. I got his name is Jesus, but his pimp name is Jesus. Slapped the whole to pieces with his plastic prosthesis. Nigga, don't you know that I'm your daddy? Said he, this is true. Plus he schooled me for my Mackin degree. Never please try not to flee, make niggas pee when you stick around. Smell my mama had found, told me to put it down. I press the gas to the ground to show that I'm a hound. Make sure they gear up the sound. It's heard throughout the town. 30 years ago, Jesus could pull a hoe quick, but now we 50 and his belly hang lower than his dick. Philosophy that he spit stuck in my memory chip. And now we putting in a disc of Gladys Knight in the pit. And then that shit start to skip. He said somebody must have scratched it, put the 40 to his lips and put the conscience down the hatchet. Flipped the foley on the floor and placed his palm on the dash. And wheezed out, come on man, make this motherfucker mash. Ain't gonna mash too fast, cause my tags ain't right. Me and Jesus the Pimp in the 79 Granada last night. City lights from far away can make you drop your jaw. Sparkling light sequins on the transvestite.
Hey, it's Soleil, and this is episode 286 of the Orange Pill Investor. And today I want to go over the Climb the Ladder trade that I reviewed over the weekend. I was very intrigued by it. I really stopped looking at spreads so much. Even just aping into long calls was kind of a departure for me as a native options seller. But MicroStrategy's kind of done some weird things to my brain. So I barely have even any covered calls on at this point. And MicroStrategy's liquidity is not that great. So I just really just stopped looking for spread opportunities. But the video was very intriguing, but before I get to that, like that's just going to be straight gambling to a certain extent, which is appropriate because the formula that I basically use to determine whether a spread is worth doing is using the Kelly criterion. Kelly criterion basically is what gamblers used to bet size appropriately so that they never go broke. And the stronger of the advantage, the higher the bet size that you can make, or a larger percentage of your portfolio. And in the case of selling spreads, you want to receive more than the delta that represents the percentage chance, that you will fail, right? So whatever percent you're going to fail, you need to get paid more than that, per, basically like on a, per 100 contracts basis, right? If you lose 25 bets out of 100, you need to get paid more than 25% of the potential losses. You're going to, if you win 75% of the time, then you need to, I'm sorry, I might have said that wrong. So if you're going to lose 25% of the time, yeah, you need to get bigger than a 25% credit, right? So 0.25 delta, you need to be getting, if it's a $10 wide, then you need to get at least 25 out of that. Anyway, it's going to make more sense when I look at the when I actually look at the options. But it's in reverse. So if it doesn't make sense to sell it, it might make sense to buy it. So let me just quickly look at the, I'm sorry, that's the dessert though. That's going to be the fun gambling. Okay. Somebody did tip me about Legend, so I need to grab that. But for now, let's just do what we got to do. So that's dessert. That's going to be the gambling. That's going to be the lottery ticket. For now, I know I got assigned 100 shares of CLSK and 100 shares of RIOT because the price went below my strikes. I think I was selling like the 16.5 or something, CLSK puts. Let's just look and see. So my average cost is 13 now. I had sold the 16.5 puts for $100. So I got assigned at 16.5, but I got paid $1, so that lowers my cost basis down to 15.5, which is fairly reasonable. So I've got 300 shares now, and I have 2 covered calls on at $13, which is they're freaking in the money. So those look like they'll end up getting called away, which is completely fine. Let's assume this is my cost basis, even though we know it's way less than this because I've been collecting premiums. But as long as I sell a covered call over this, then on paper, this would be a profitable trade. I generally like to try to collect like 10% up from whatever the current price is. So we're at 14, so as long, maybe I'm going to 15.5. So if I sell this covered call at the 15.5 strike, that's $1.50 in call away value, the distance between the current share price and the strike price. So I will profit $150. If this goes to 20, I'll lose out between 15.5 to 20, but I will gain $150 from the current share price of 14 to 15.5. Plus, I will have gotten paid this extra, 40 cents times 100, since this is options, makes $40. So let me just try to get filled at the mid price. Cha-ching. And let's do the same thing in RIOT. What's up, 500? 500 says, what do you think about the CLSK warrants? The redemption price is around 256. Why would anybody agree to that? I'm not going to bullshit you. I have no idea what that is. So I don't really do a whole lot of research into these mining companies. I'm a believer in Bitcoin. To an extent, I'm bullish on Bitcoin derivatives, but my number one position is MicroStrategy, and after that, I think I know enough about Tesla to be a believer in them as well. But these Bitcoin mining companies, I don't have any love. I don't have any particular preference for one company or another. The reason that I'm investing in CLSK and RIOT has nothing to do at all with how much, hash power they have, anything to do with their fundamentals. It has to do with the fact that they're highly liquid. So when I go out here and I want to sell a covered call, and let's see, I want to make this at least $1.20 up, so let's go to $13.50. When I open this up, I want to see a nice tight bid-ask spread here. So I can get into this trade easily. I can get out of this trade easily. There's a good amount of volume, good amount of open interest. This makes me happy. So I did have positions in Mara, but I kind of keep one eye on the news, just to see if there's anything that is a no-go for me. And I can't remember if it was Casper or not, but Mara started mining some kind of shit coin. And I was like, all right, that's enough. I'm done with Mara. But before that, I was perfectly happy to trade it. Liquidity was great on Mara, but I just can't be bothered if it's not just, Bitcoin only. So, sorry, no answer to that question. So let's try to get filled on this one at the mid as well. See if I can go 2 for 2. Nice. Okay, so I got paid $24, which is about 2% returns on its current price for the week. I didn't even check what my average cost for this is. Okay, good news. So my average cost here is way better than CLSK. That should probably do it. I've got 300 shares of CLSK, 700 of RIOT, and I've got, one covered call, so 3 covered calls in CLSK. Got 1 and 5 is 6, and 1 more, 7. I got 7 covered calls in RIOT. So we have eaten our meat and potatoes, and now we can have dessert. You can't have any pudding if you don't eat your meat. So now we can take a look at MicroStrategy, and Climb the Ladder had a very interesting, notice something very interesting about the delta on the options prices. And the strikes, I'm going to choose, well, I'm probably going to choose this strike as well, but I'm going to choose some different ones to go along with it. And this has adjusted slightly. So when he did the video last week, the delta on this was like 0.23-ish. But it's going to work out to about the same thing. This just means that a third of the time, this should go in the money. So this will be a winner 30% of the time, which means when you put this spread together, it should cost approximately 30 or more on this $100 wide spread. But you can see that not the 660, the 760. No, I'm sorry, I did the 600. I need the 700. These are the strikes that he was looking at. And it's roughly the same price. It was like 520, I think, in his video, something like that. If the delta is 30, then we should win this about 30 times out of 100. And when we're winning it, we're going to get somewhere between, like, if the price goes to 650, it's going to be like $5,000. So you're risking 600 to win 5,000. And if if the price goes to 700 or 750 or whatever, it's risking 600 to win $9,000. So this is definitely asymmetric, and either this delta is wrong or this spread is undervalued. These Greeks are just projections. This is just models spitting out numbers. And really, people, and I've said it this way myself, I'll say, high implied volatility means high options prices. But that's actually backwards. High options prices means increased implied volatility. So you put the option price into the model and it spits out the implied volatility. You don't put implied volatility into the Black-Scholes model and spit out the options price. The options price is the combined activity between all the buyers and sellers. So everybody at the bid versus everybody at the ask, somewhere in between there is the price. I'm not saying market makers can't try to game the system and either buy up a position or short a position to screw people over and push them out of their in the money positions or whatnot. There's a little bit of conspiracies around that. However, it's not like they can just decide what they want the price to be by manipulating the Greeks. That's not how it works. So this seems like an asymmetric bet, and I don't really have a lot of buying power on Robinhood, but I could place this trade here. Should I place this one in Robinhood? Why not? I'm here already, right? So let's see if I can get a fill at the mid price. I kind of doubt it, because it's a little bit harder to get. Oh wow. Okay, so that actually did fill. That's kind of surprising. I might have overpaid for that then. Maybe I should have put in 6 or 625 just to try to get a little bit of a discount. I was kind of expecting to have to go up to 7, honestly. So that's interesting. But in general, you're welcome, 500. So in general, I try to keep spreads down to like maybe 2% of my total portfolio. And this account's worth 20 grand, so 1% would be 200, 2% would be 400. So this is not too bad. Like, this is not taking too big of a risk here. But I'm going to do the other ones in Tasty Trade since I have a bunch more buying power here. And I'm just gonna do a couple of other strikes. So the trade that I just placed was the exact one from Climb the Ladder's video. And this one, I'm going to slide the strikes up, and I'm just going to go all the way to the top of the chain, which means I have to buy, if I'm still going to make it 100 wide. And really, if you don't want to risk, well, sorry. If you don't want a $100 wide option, you can always go, shorter. So the price, the debit will be lower, but your max profit will be less as well. So maybe I'll just do one of those too, just for the hell of it. But since the 760s are the highest available, I'm going to go out here and I'm going to sell the 760. And I'm going to buy the 660. So it's still going to be $100 wide on the strikes. And you can see this is back much closer to the $5 price that he had. And the same thing, the delta, is a little bit increased because I think the price might be a little bit up since Friday, $10 a share maybe. So the delta is no longer like 23 and 27. It's, well, was it? Yeah, 23 and 27. Now it's 27 and 23 here. And that's actually very, very close because I slid the strikes up. So he was looking at the 600s. So now the 600 and the 700 is 0.3 delta and 0.25. So those are different. But actually these strikes are kind of recreating the exact same deltas and price that he was talking about earlier. So this time I'm going to try to buy a little bit below the mid price and just see if I can get a fill here. And that's $500. So do I want to go in a little heavier? Let's do 5 of them. All right, so trying not to overpay. So I did go a little bit below the mid price. So let's go up to 475. Okay, cha-ching. Hopefully that wasn't too loud. All right, again, the likelihood of success is only about 27%. But I only paid, sorry. So my position here, where's my spread? There it is. So my position cost me, now see, I hate the way that Tasty Trade does this. Let's do, okay. So I paid 475, right? Or actually, I got filled at 468. The max profit on these bad boys is the difference between the strikes. So that's $100 times 100, since we're talking about options here. So 10,000 minus the $500 that I paid. So max profit, if this goes to like 775 or whatever, is 9,500, and the most I can lose is $500, which is what I paid for it. Now, and just to be fair, and full disclosure, I do consider this kind of gambling. Like, I don't have the slightest idea what the price is going to be between now and January. So this is just crossing my fingers and hoping there's a little bit of a mismatch between the delta, like even if the delta here isn't 0.05, even 0.1 or 0.15 would still be an advantage for this particular option. So I'm willing to risk, you know, $500 to potentially get almost 10,000. That's what, 20 to 1. But I'm gonna go ahead and do something even a little bit more degen. That and I would have liked to have done this. I should have done this a little faster. I would have much preferred to get into this position when the price was down this morning, but I missed my chance. Will says, missed the beginning. There was an issue with the link. Can you quickly explain the strategy? Yeah, so I covered climb the ladders strategy over the weekend, and I'm going to do another one so you can see this. But basically, he noticed that there was a little bit of a mismatch between the delta on the long call strikes and the risk to reward on the spread. So if I wanted to do something just for this week, and I want to go to basically like 25% chance here, and I buy, let's buy the 405. Actually, we might as well just buy the 400. And if I make this like $50 wide, well, let's look at the $100 wide. This one, I'm spending $800 to potentially win 10,000. And if the delta is accurate, then the price of this spread should be around like 29, not 8. So this is straight gambling, right? This is just assuming that I'm bullish on MicroStrategy in general. So I'm going to place one of these bets as well. I'm not saying this is smart. Like, it could just be that the price is accurate and the delta is mismatched. Like, maybe the delta on this really should be 0.08. But just for fun, I'm going to, put a little bit on the line for what could be an asymmetric bet. And this is on weekly, so I only have to wait 4 days to find out if I lose my $800 or not, right? And I could ride this out and, win or lose, right? I could just decide that I am going to let this print or die, right? If it's under 400, and if it's under 408 by Friday, then I just threw away $800. And if it's over 408, then I will have profited some amount of money. And I will have to escape the bid-ask spread as well by then. So liquidity on MicroStrategy kind of sucks, even though I was hoping after the split that the liquidity would get better. Actually didn't have a hard time filling this position, but there's no guarantee that the liquidity entering this position will be the same as the liquidity trying to enter it on 0 days to expiration, right? At that point, the future will be pretty close to being known, unless MicroStrategy is literally sitting at like 395, 405. That's going to be an interesting decision to make. But if we're still trading at 360 on Friday morning, and I know this is a loser, and if we're trading at 450, then I basically know this was a winner. And I could try to exit that position for, big money, or I could, if all I wanted to do was double up on this and the price runs early, I could sell on this for like double what I paid for it. I paid what? What does it say? Yeah, I paid like $800 for it. So I could put this in and say, okay, I want to sell, for 1600. I could put that in. But I'm just going to watch it, and I think I'm going to go ahead and place another trade that's a little bit more at the money. So this is going to be more of a coin flip, but I'm still going to double check on the math. I want to make sure that the math makes sense first. So I'm going to buy the 355. That's basically at the money. You know what? Let's buy the 350. Just make it nice, round whole numbers. And then I'm going to sell the 450. So I'm going to keep these all 100 wides. And this is going to cost me much more, which makes sense because I'm taking much less risk. This basically profits if the price is over 350 plus what I am paying for it here. So it's got to go over 371, which is a lot easier to do than getting to 400. But does this make sense? So the delta on this is 0.58. So yeah, it's like a third of the price. If this was accurate and there really was a 60% chance of being in the money here, then this should cost closer to $6,000 instead of $2,000. So I'm going to go ahead and place this one as well. Doesn't necessarily mean that this will print. It's just kind of taking a flyer on whether that delta is actually accurate. I think the one for January is probably a lot safer as well because there's a lot more time for something amazing to happen with the price of MicroStrategy. So this weekly one, this is definitely some YOLO shit. But it's kind of fun. All right, so I've got it's hard to put these back together again. So I've got the 350 and the 450. And I've got the 400 and the 500. This is forming a call debit spread. Then, of course, I've got the one that's an exact match from, I think I matched it up to Climb the Ladders video. Went ahead and placed one of these, right? Where is it? Yeah, I got the 600, 700 call spread. Now, did I do... No, I didn't do January. Yes, I did. I did 5 of them. Yeah. And so I also have the 5 of the 660, 760 call debit spreads. Those are going to be fun to watch as well. So I think that's all I need to do. If MicroStrategy gets to 370, somewhere between 370 and 400, I will add another covered call here. But I don't want to shortchange myself on upside by just plowing into more of them at this point. Let me just look and see if there's any that I can close. I doubt it. Yeah, these bad boys, I'm probably going to end up having to pay to roll. This one, I have a chance to escape this one. But the price is definitely going against these, which is fine. Overall account is going up. So happy with that overall. All right, so that's everything that I think I wanted to cover. Let's check the chat. Will says, makes sense. Thank you. You're absolutely welcome. Hella Fire, good morning. Good to see you. Yeah, as soon as if anybody's got any questions or comments or wants to look at any expirations, want to look at any strikes, you want to look at any particular strategy, let me know. Speak now or forever hold your peace. As soon as we finish up with that, my break will be over and I'll have to get back to work. All right, Hellfire says, what would you do with a 350 covered call that expires on Friday? It's in the money. So, I mean, I generally don't like to roll them early. But how long ago did you place it? Right? Has it been on for 45 days and now there's just a week left? I think that would be reasonable to roll it if you intended to. But if you just put it on like Friday, then I don't know that there's much to do with that one. So actually, yeah. So I do have the 350. No, I'm sorry. This is my spread. What do I have in? Yeah, I have the 350s, but these expired December 20th. So in general, I don't roll early just because my short strike is in the money. What I do is, let's just take a look at the 350s. So right now the 350 is in the money. When they're out of the money, the calculation is just whatever the option price is. That's all extrinsic value. So the first thing that I do is on an in the money option, I have to do a quick calculation to find out how much is intrinsic versus how much is extrinsic. The extrinsic value is going to be the time value left. And that's the decision, that point for me of whether I leave this on or not. To find the intrinsic value, you have to subtract the strike from the current price, which is basically 5, so $500. And when you subtract the intrinsic value from the option price, the mid price is $23.85 here. Subtracting the intrinsic value from that leaves you with $18.85. So there's $1,800 worth of extrinsic value that you can collect if you don't close this trade. All of the extrinsic value has to disappear from an option by expiration. That's just how it is. Now, that doesn't mean that the price won't run to 400, which would mean now there's $5,000 of intrinsic value in the option on expiration and 0 extrinsic. So no matter what, you're going to collect this extrinsic value, this $1,800. But if the price goes to 400, you're going to lose 5,000. So it's not necessarily a done deal that you wait until expiration to close or roll, but it's just what I do because I hate, like if I'm like, oh shit, it's 355, so now I want to roll this position to the next week, right? If I roll out to the 350 for next week, I can do that for a credit. I'm going to get what, $800, $900. But I'm paying all of that intrinsic value and extrinsic value to get here in the first place. So I'm only increasing the amount that I can collect. And I'm just kind of in the same boat. I'm just kicking the can down the road. So I don't roll early because I don't want to pay to roll all that extrinsic value. So for me personally, I just wait until, maybe the day before expiration to decide when to roll or whether to let my shares get called away, etc. But if I'm scared and I know I absolutely don't want my shares called away, then I would just exit the position. Like if I'm not prepared to risk losing my shares, then I just don't open that contract in the first place. Okay, so 10 days ago. Yeah. Yeah. If I'm nervous about the stock running up, then I just don't sell covered calls in the first place. Um, but if I intend to just keep rolling, then I just wait. I just wait until expiration. Oh, didn't put your shares at risk. So oh, I'm sorry. You didn't sell a covered call. You bought. You're long the 350. So I've been explaining the wrong situation, right? Confirm that. You're long the 350, not short the 350. Okay. Big freaking difference. So you're not in the situation that I'm in. Okay. Yeah, in that case, I mean, I'm assuming you're in profit then? So I don't like buying calls a week or two out. They scare the shit out of me because as an option seller, barely. Yeah, I can't make any short-term predictions. Like, normally in life and like even the weather, we know short-term thing we have very high confidence in things that are going to happen today, tomorrow, next week, and we have very low confidence about things that are going to happen next year. But for me, I have zero confidence on what's going to happen on MicroStrategy from day to day or week to week. I don't have the slightest idea whether MicroStrategy is going to be 300 or 400 this Friday. It could go either way. It could even be worse than that. So I don't buy calls for this week or next week. I buy calls. I mean, I do have some Januaries, which is I still kind of scares me a little bit. And because I'm so nervous even about the Januaries, I had bought 10 of these and 20 of these, right? And as soon as I was able to double up my money, I sold half of my positions so that the worst that I could do is break even. So even at how many days to expiration left on these? Even at like 60 days to expiration here, these scare the shit out of me as buying calls from an option seller's perspective. Anything under 90 days starts to give me the creeps. So buying long calls 5 days from now, 10 trading days from now, absolutely scares the shit out of me. And it just doesn't justify the risk, right? Like April's like $7,500. Hell, you can get April's for that. You can get a June 760 for that. And that just gives more time to be right. So, these call debit spreads that I did are, I did some for next week, but it's a very tiny, portion of my portfolio, and it was kind of just for fun. But I'm generally kind of terrified of long leveraged calls a week or two away. I generally steer clear from them, and that's when I'm dying to sell them. As an option seller, that's when theta is just killing those contracts. So there was a penny stock trader turned crypto trader named Quick Fingers Luke, and he said number one, you always participate in the bounce, so you always take profits when you can, at least a little bit. But the other thing was that he said that even a break-even trade is a win. Like, there's so many people that lose money in the stock market, if you can just place a trade and then break even at some point, at least you live to fight another day. So gambling on whether the price will be 350 this Friday or not scares the daylights out of me. All right, Forrester says, in related to long calls, why do you have to pay for the contract if you also have to buy at the strike price? Gotcha. So think about it from the seller's perspective. What incentive does he have to sell you at that strike price for no benefit? Like, you've gotta pay for the time value. So nobody's gonna. Let me think about this. Right? If I want to enter into a contract because I think the price is going to go to 400 this week, right? Like, why would someone sell me a contract agreeing to give up their shares at 400 a share for nothing? Like, they can just hold on to their shares. So they have to be enticed to part with their shares at 400. So there's got to be some kind of extra premium that the buyer is willing to pay for the control. And that's basically what you're buying. So the buyer is buying the right but not the obligation to buy those shares. So really, you have downside protection as a buyer, right? If I buy this 400 strike here, I'm limiting my downside to $937. That's the most I can lose. But if I pony up 40,000 for $358,000 for 100 shares, and MicroStrategy goes to zero for this Friday, now I've lost $35,800. So I'm also limiting my downside. The most I could lose on this 400 strike long call would be $917 at this current price. But I get to control those shares. So I have to be willing to pay something for the seller to relinquish control of their shares. Otherwise, they can just maintain positive control over their shares, and they can collect all of the profits if it goes to 500. So you've got to give the seller a reason to sell. Otherwise there's no incentive, really. I don't know if I explained that very well. Hellfire says, bought it because the RSI told me to. Yeah, I don't do any technical analysis. I did hear someone talking about RSI, and they claimed that anything under like 95% or 5%, I can't remember which one tells you to buy and which one it tells you to sell, but he said anything that's not that an extreme has no correlation whatsoever. So if it's just like 20 or 80 or whatever, this guy claimed that that's not even a signal. It has to be an extreme RSI position to even move the needle, in his opinion. I don't even remember what channel I was watching, but that was the claim that this guy made. And yeah, I don't even do TA other than, I'll go to the SPY. Like, if I want to know what the overall macro environment is, I'll go to the SPY and be like, oh, okay, well, the 50 is still above the 200 simple moving average. We're still kind of in a bull market. And, we had a golden cross back here in January 2023. So technically we're in a bull market, right? And back here, when we had the death cross, we were technically in a bear market, right? I mean, I think it's kind of good to know what the overall macro environment is, but beyond this, I don't do TA. So I can't really help you with RSI about whether RSI is a tradable metric or not. Forster says, makes sense to lose that initial contract payment if the stock never reaches the strike, but if it does, is that payment returned to me? Not exactly, no. So, especially if you're buying an out of the money option. So, out of the money options have no intrinsic value because you can't, if you exercise them, you would lose money. Only in the money options have intrinsic value. So if you're buying an out of the money option that and you hold it till expiration, all extrinsic value has to decay out of an account by expiration. So on expiration day, if it's in the money, then all of the value is intrinsic, and it's just basically going to be the share price minus the strike price. That's your profit, and there's no extrinsic value left. Only options with time value has extrinsic value. So in that sense, no, all extrinsic value is decaying, and you're never going to get that back. Now, if you buy something that's 6 months out and you sell it after 3 months, then yes, you're going to get the remaining 3 months of time value would be reflected in that option price, and you would get that back when you sell it. But if something goes in the money and you hold it, anytime you hold something to expiration, then the only value is the intrinsic value, which is the share price minus the strike. All right, Hellfire, I have calls that are 30, 60, and 365 days out. I did it for fun, and the stock ran to 380 and retraced to 325. Yeah. Bought it when the price dropped. When that price ran up and dropped, I thought that in the next 10 days, the price could run up again. Yeah, the price can do whatever the hell it wants to do. And the other thing that kind of scares me a little bit is sailors out there selling at the market every day. So every time the price runs up, he probably, steps on the gas pedal a little bit and sells a little bit more. So with the price being flat, maybe he's just out there selling a little bit. Like, I don't know. That's just kind of all a guessing game. But he's constantly, announcing that he's bought more Bitcoin, and he tweeted on the what was it, the sailortracker.com or whatever the hell it was. It tracks all of his buys, and every green dot was them buying more Bitcoin. And he's like, this graph needs way more green dots. So he is just buying as much Bitcoin as possible. And in order to buy it, he's got to sell MicroStrategy to line his pockets with spending, with buying power. So, and he's explicitly said, look, I am not trying to pump the stock in the short term just so that people can be in the money on their long call strikes. So that's kind of a signal to me to be very careful about things that are under 45 days to expiration. Like, I need 60, 90 days to expiration to make me take the anxiety, take the little bit of knots out of my shoulders. All right. AIK says, thanks for explaining the climb the ladder trade. Absolutely. It was, I really liked it. He said, it was titled like When Delta Lies. And I was like, okay, this is going to be interesting. And I sometimes it's weird for me because I have a disconnect when I go from X to YouTube. I feel like, oh, okay, that's a completely different community, but we were actually already following each other on X. So it was kind of funny that I didn't even realize it until I responded to one of his X, a tweet he had, and I was like, wait a damn minute, like I just watched YouTube videos by you. So that was kind of cool. My I guess the Venn diagram of my YouTube community and my X community has some overlap. So that was kind of cool. All right. Thanks everybody for tuning in, and placed a fun few little coin flip YOLO lottery ticket trades in positions, sized to an amount that will not, sink my battleship or anything. If I lose that money, it's fine. And it was fun to do for the video. I guess I got to say, not financial advice or whatever. It's definitely taking a risk. And still it's fun to do. And if it works out, then I probably owe him a huge thanks. So in any case, it was good. It was good. Good topic for a video. So be good, y'all.